All right, we are live. The channel says preparing to live stream. There's always a delay, so it's a bit of a mess starting out here. But this is the Investing Power Hour. This is number 14. So we're getting in the teens. This is becoming a consistent routine for us. If you're wherever you're listening, you can watch this every Thursday at 12 p.m. Pacific time or 3 p.m. Eastern time on YouTube. Just look at the Chit Chat Money YouTube or wherever you listen to podcasts. You can re-listen to it, and it comes out every Sunday. All right, Ryan, the only rule for this show is no preparation. So how are you feeling about the markets this week? We're back. The markets are back. Everyone's
Dead
happy
cat
again.
bounce. Dead cat
Yeah.
bounce.
Okay. It will be.
I don't know. The problem is everyone keeps saying it's a dead cat bounce, which makes me think like maybe it isn't. But and it's happened like 10 times on the way down recently. So I feel like everyone's just like, oh, it's gonna happen again. But I don't know. I don't really care. I don't care, but it's pretty entertaining.
It is fun to see, and it obviously affects us as well when short-term moves are so volatile, upwards or downwards. It can really affect your emotions. It's tough to be aware of that, if you get what I mean.
You know what's funny is no one, whenever I hear people say like, obviously it's volatile, no one's ever referring to the upside.
That is true.
Like they're only referring to the downside. Whenever I hear people like recommend some crypto, they're like, just be aware that it is volatile. It's not them saying like, oh, it could go up a lot. It's them saying like this could go to zero. And so it's like, I don't know. I hate when people use the word volatile. You could just say like this is risky.
Well, that's true.
They use it in the wrong. Volatility used correctly can be useful, but just in that it can have swings either way. But no one ever uses it that way, I feel like.
Yeah, agreed. Everyone talks about it as basically market drops. And well, there's a lot of volatility on the way up in a lot of stocks. Blow off tops February 2021 throughout the last year. So who knows? All right. Anything you've been looking at this week? Anything interesting? I've been thinking about meta platforms. I know we discussed it last week. I don't know. I think Instagram, it feels like everyone is still on it. And that's all I got to say. I feel like that's the long thesis right there at this price.
Yeah, it is. Like I was at a large gathering this week, and there were a lot of young people, and everyone's still on Instagram. Like
that's true.
The world's still like a lot of people live for Instagram. They're like, oh, I'm gonna go to this place solely to get a picture so that I can post it. I'm like, when
Yeah.
I don't know.
Was this
maybe that's the meta thesis right there?
Yeah. Was this our producer / co-owner of the company's wedding?
Yes.
Congrats to him.
The man behind the glass.
The man behind the Zoom. Brady, Ryan's brother, third member of the team. So everyone, I know he's not on in our socials, but everyone, good thoughts. He had his wedding, so congrats to him. But yeah, that is the prime time. I mean, weddings. I mean, that's got to be one of the number one. Besides maybe like those big music festivals or concerts, stuff like that. I mean, weddings is prime time Instagram. Glorification? I don't even know what the right term is, but
it's the right much. It's a perfect Instagram event, I guess, is probably the way to describe it. It wasn't even like that. Like I feel like some venues are literally Instagramified, if that's a word. Like they've been built for people to take pictures and post them. This was more just like, it's a wedding, you take pictures, you'll probably post them, but I don't know. Like Instagram, I think still rules social media. I know TikTok is like consuming people's hours, but I've heard, and this is not that useful, but I've heard a lot of people get exhausted of TikTok because it's so they spend so much time on it and it becomes so addictive that they have to get off. As opposed to
Gotcha.
Instagram, it's like a durable addiction, if
Right.
that makes
TikTok.
sense.
Yeah. No, I got you. TikTok is meth and Instagram is caffeine.
That's a good way to put it. I was gonna say it's like it's too hard of the social media drug. It's that
Yeah.
Instagram's more
I
easy,
know.
easy, easy.
And we're not even talking financials about anything. But I mean, that feels like the log thesis right there. And it's more dominant across the world. India's banned TikTok. All right, but we talked about that last week. Let's do other topics. Oh gosh, there was one on my mind, but we're not supposed to prepare. So let me go through my
I spent
minutes.
some time like just filling out some doing some spreadsheet work for Dropbox this week because it's overdue, and that business everyone thinks is dead, but they just keep growing. And
It's
I know we
interesting.
own it, so it's like just I don't know if you're a listener, be cognizant of that. But everyone hates them. They're like, oh, the platform's gone nowhere, but subscribers have gone. Revenue, I believe it's compounded at like 18 or 19%, like high teens. I could probably pull it up right now, actually.
I think
Which if someone,
maybe, are you sure it's that high? I thought it was slightly lower, but maybe it's slowed down recently.
yeah, it was a little faster up until last year, but I'm gonna pull it up because as of the most recent quarter, uh, as in the most recent quarter, revenues compounded since 2018. Q1 revenue has compounded at 15.5%. So not as high, but as a last year from 2017 to 2021, it had compounded at 20%.
Gotcha.
So
Gotcha.
a bit of a slowdown, but still quite a if you just read the financials off and you said, all right, name this company, grew revenue north of 15% for the last 5 years, free cash flow margins of whatever it is, 30%, reducing share count, most like 16 million, I think it's what it's at, subscribers, and has raised prices by 5% a year. I don't think most people would guess Dropbox.
Yeah, it is. It's weird whenever, so like say we're having a conversation with someone and we say, yeah, we own Dropbox. We think it's really cheap, durable, and people kind of just do the same. And it's not like against nothing against
It bores them.
people.
It
Yeah, they
bores them.
go, that's boring. And they say, well, isn't Google just going to eat their lunch? Isn't all those other companies just going to eat their lunch? What have they even done? And to me, that is honestly a bullish indicator because you want the stock cheap if they're going to run this buyback program. But
Yeah.
here's something, a different topic. Wait, let me pull up the like tweets here. Okay, this is a good tweet from, what was it, yesterday? From Frugal Mogul, which is a good name on Twitter. You can have either $5 million today or $1 billion in 60 years. What do you pick?
So I saw that tweet and I saw someone did the compounded growth rate.
The discount or something? Yeah.
Yeah. I think it was like 9.5%. I think.
Oh, you think you're gonna have to perform that?
I'd like to think that I could, but I'll take 5%, or I'll take the 5 million now, purely because I would just want it while I'm younger.
That's true. The
Like
interesting
like
thing
there's just
though,
less things I can do with $1 billion when I'm 80 than when I'm than 5 million that I could do with when I'm 20, 25, say.
and we're not allowed to take out debt. Basically, like someone like Berkshire Hathaway gives you, some of the money now at an interest rate for the $1 billion. If you get what I mean, we're not allowed to do that cheat code.
Yeah, no. I'm just, it's more fun to have like in my mind it would be more fun to have 5 million at the age of 20 than $1 billion at the age of 80.
5 million at the age of 20. Yeah, I agree. It's dangerous though. But you could, yeah, if you don't have that cheat code, you're obviously not getting it until
And
you're 80.
let's assume that from here, the index dividends reinvested annualizes 8 or 9%.
Yeah, I'd probably say more like 7, but
We are off what,
conservative.
20%?
Yeah, but still, I mean,
whatever.
yeah,
Everyone, but everyone's been saying that for the last 25 years. They've been saying, well, it's not going to compound at that high of a rate.
true.
And it's stayed. So maybe we're wrong. Let's say it compounds at 8%. I would rather have I would rather take the risk that I could do it myself and get more.
Yeah.
Because that process is more fun too. The whole life's too short to index, and you're basically getting index performance from 5 million to $1 billion in 60 years.
Yeah, I totally agree with that. All right, here's another thing. So there's the Amazon Prime Day, which is kind of a weird thing, but Buy with Prime launched in conjunction with this for a few websites. I think they're still kind of beta testing it. I went to one of the websites. There was nothing that interested me. It was like weight loss stuff. One of those kind of sites that gives you those like powder bags that are like these weird nutrition things are going to help you lose weight, blah, 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 magic stuff. But everything costs like $50 for one of those pouches. But even before you go to add to cart, so it's not Buy with Prime isn't going to be when you click add to cart and then go to your whatever payment thing. It's actually before that. So you have add to cart or Buy with Prime. And when I clicked Buy with Prime, I had to confirm my login, which it's already on the computer. So I logged in, and then it has my credit card information already. It has my delivery address already from Amazon. No shipping, next day delivery. No shipping costs and next day delivery. It was like a 3-click process. I think that if they execute this correctly, it could be dangerous for some of the website builders or the payment stuff associated with that. But it's a huge industry, you know.
It could be dangerous it could be dangerous for the website builders that generate a lot of their revenue from the transaction process.
Yes, exactly. Or I mean,
because okay, I will say this.
So or even PayPal, maybe.
Yeah, we own. Is Stripe in that? Is Amazon a Stripe customer? They're not.
Oh, that is a good question. I want to say I do not know this for sure. I want to say they use something from JP Morgan, but yeah, Stripe. I mean, Stripe and Shopify have a huge partnership.
Yeah, that does feel like a bit of a killer to a large portion of Shopify's revenue. It's such a good, the value of Prime just keeps growing. And now you're seeing the Grubhub thing.
Oh yeah, that's what I wanted to talk about. Let's talk about that next. Table that. Let's talk about that next.
Infrastructure as a service. That's what it is, right? Essentially, IaaS.
Sort of. I mean,
it's such a brilliant move. And I can't believe, yeah, they have to execute it right. And I would think that this gets a lot of adoption. Maybe I'm wrong. Maybe merchants like just don't want Amazon involved at all. But if they do and they understand the convenience for customers, this is like such a brilliant move. And it took them a whole bunch of excess fulfillment capacity to do it, which shocks me. Like why were they waiting? It was like they built it all out, said, wow, we overbuilt. How do we service this now? Oh, we'll let other people on. Well, why didn't they do this earlier?
Maybe they just couldn't be, but I don't know. I think they wanted to go out with a bang, because if they had to beta test this for a while, say like 2-3 years, they didn't have the capacity to roll it out to a ton of people because they were worried they wouldn't be able to fulfill 1 day or 2 day shipping. Maybe that would give someone like Shopify a chance to counterpunch. And now if they can roll this out within 6 months or something like that, it's just going to be tough for Shopify to respond and everyone else, really.
Yeah, the good thing, this would suck. So Shopify isn't the only one that has added this. A whole bunch of other websites have added it. Wix has added it for any of their merchants.
Big commerce or
BigCommerce, Squarespace, I assume, has added it. I imagine all the website builders have, but Shopify has the most revenue from transactions as a percentage of their revenue of the other website builders. Most of the website builders generate the largest portion of the revenue from the subscriptions. Shopify, now potentially to their detriment, has gone beyond that and made it the transactions, which whatever, they still have the core subscription business, which is great, but the market has priced or did price in
still priced in, definitely.
growth in transaction revenue. So it's, I don't know. It would worry me as a Shopify shareholder, but I've also heard the argument that there's a little bit of reluctance from the merchant side to include anything Amazon related in the process. I would think though that they would know better. But
I think that's anecdotal, but not in practice, because you can still almost everyone, but what, like Nike, the top brands have their stuff on Amazon.
yeah, who are the brands that don't? Nike, Lululemon,
Apple,
probably.
I don't know for sure Lululemon, but I believe so. I know Nike for sure. That was a big thing. They had a spat with them because of the knockoffs, stuff like that. I don't know Apple. There's been a lot of discussion with that, but I believe they do not, and that is right in their ethos. But yeah, most people are going to be on there, and
I feel like Apple wouldn't even. I feel like Amazon wouldn't be that useful to Apple.
Yeah, it's not that. Yeah, and they're not that useful to each other. All right, let's talk about the Grubhub thing, because this was interesting. Let me just explain what it is.
Yeah, explain. Yeah.
Okay, so if you didn't see, if you are a Prime member in the United States, you can now get Grubhub Plus, which is basically their own Prime thing that Grubhub had for free food delivery. So any restaurant that is a part of Grubhub Plus, you don't have to pay delivery fees on your food delivery.
Yeah, the customer would typically, if you were going to subscribe to Grubhub Plus, you would pay $9.99 a month, and then you get delivery from all the restaurants that have signed up to be a part of the program. You get delivery for free. You still have to obviously pay for the meals, but you get the delivery component for free, or you get it for that $9.99 a month. Now you get it for free if you have a Prime membership.
Yep, I connected it already. I don't use food delivery very often at all, and really I wasn't using DoorDash or Uber Eats unless they would give me a fat coupon, because, well, it's super expensive, and I can, I'm not in a place where it's that hard to drive and go get something, or walk and go get something. But this could be, I don't want to overhype it because food delivery is a bad business, but if I'm DoorDash, I am sweating right now. I mean, this seems, for one, here's why it's such a big deal, is because so many households in the United States are Prime members. And if you can get this account on there, and basically Amazon's going to say, okay, this is kind of how I'm envisioning it, because the economics on this are probably poor, at least at the start. Amazon's going to take a brunt of this, the losses that are going to pile up at the start, right? Because when you're offering this for free for Prime members, they're going to do a revenue share with Grubhub, whatever it is. What am I trying to say here? It's not going to, the unit economics would look terrible at first, but Amazon has so much capital that they can absorb this easily. And then Grubhub has fallen behind really, really badly in the United States, but I honestly think this could save them. It doesn't mean that the business is going to be good, but I think it's more of like a bad thing for Uber and DoorDash.
Yeah, that's what I thought initially as well. One thing that matters though is the actual restaurants that are on the program. I've heard from people that use DashPass or Grubhub Plus type of thing, that a lot of the restaurants opt out of that stuff,
Mm,
or that they have like a different charge. Maybe it's like reduced, but it's still not free. And so people feel like the value isn't there. I guess if you have the Prime membership, it doesn't really matter. It doesn't really cost you anything. But I wonder if people just aren't, if maybe people just don't end up aware that they can get the Grubhub Plus thing,
yeah,
because
but
maybe Grubhub doesn't have the reach to tell people, unless
Amazon
Amazon,
does.
if
Amazon
Amazon
does.
makes it very clear, then maybe it's worthwhile. But I think a lot of people already use DoorDash enough that it's just like habit.
Yeah, but I
I
think
check both apps, but I am the rational consumer.
I mean, okay, here's the thing. Yes, there is probably a little bit of switching costs. I don't know if that's even the right word. People stick with their app, right? You're maybe already paying for Dash Pass. You get the whatever the partnerships they have, I think, with some credit card companies. However, this is such a better deal. Like, I would think if people's wallets are tightening, which they are right now, I just don't. Yeah, I guess not everyone's the rational consumer. Not everyone is trying to think so frugally like us. But I mean, this would get me back into food delivery, if you get what I mean. And I was basically out because it was so expensive.
Does okay. So it gets rid of the delivery fee. Does it get rid of the random fees that are
I
also
haven't tried it.
associated with it? The transaction fee, the
I I haven't tried it
Seattle
out yet.
fee.
Yeah, I haven't tried it out yet. So I will report back if this is more. This is not the game changer I'm thinking.
Because the amount of
But
times I've bought like a burrito for $8 or $10, and then it's $22 after fees,
yeah,
and
I'm done with that stuff. Yeah, I mean,
like
it's not.
I'll
I'm not.
drive.
I'm not doing that. Yeah, it's ridiculous. But
I actually got a Uber, just like, I swear, like once a month they'll say like, here's a $20 gift card. I'll be like, all right, with for your first order, and so I'll use it.
or
Maybe
50% off. I get that email. 50% off.
the 50% off still might not be worth it after fees, but they gave me a $25 gift card for my first order, and I think I built some random account, and so I was like, all right, whatever, I'll take it. And then I put in the wrong address, and
Mm.
it and so I had to cancel the order, and I lost my $25 coupon. I was like, all right, I'm not buying from there. It doesn't matter. But just a sad moment. Could have been a free burrito, but it was a one burrito for $22. It's unbelievable.
Yeah,
Like a Chipotle
it's
burrito.
yeah. Which, as we all know, isn't even that good anymore. No,
Whoa.
just kidding. I mean, it's
I
not
think
worth
you
twenty
just
two
had one
dollars.
sloppy experience.
No, I mean we had that one in Iowa, but or was it Iowa? I think it was Iowa. Yeah,
Oh
I mean that's
yeah.
Iowa. It's tougher to get those fresh ingredients, but the Seattle one, it's not. It hasn't been the same anymore. I've been to multiple. It's not the
I got
same.
the I got the softest scoop of rice the other day.
All I'm
It's
asking for is
Here's the
warm
thing.
rice.
It's
It
it's
needs to be warm. Like it's sometimes it's cold. I'm like, come on, just make this warm. It's
what
poor
are they
quality.
what's it called when they don't raise prices but they reduce portion sizes?
Oh, shrinkflation.
Yeah, they're hitting inflation from both sides, shrinkflation and inflation, because they increase price of the burritos, and I'm getting these sloppy little portions.
They have been increasing the price of the burritos. Yeah. I mean, it's a tough spot. I don't think restaurants, it's a tough. I think this
I don't know.
shows that there's a lot more risk in running a restaurant than people may think. I don't know if
Yeah,
restaurants deserve premium valuations because of the macro factors, supply costs, labor costs that can bite you in the butt.
yeah, 100%. Even if you have like the best reputation, it could disappear. Starbucks is a great example.
Oh, wow. Is this a hot take or what? Oh, yeah. Okay. You're talking about the labor
No,
stuff.
yeah, the reputation with like labor, like they used
Yeah.
to be known as someone that took really good care of their employees. They used to have all those like tuition help or whatever programs, like scholarships,
Mhm.
and now they're seeing the rise of all these unions and hearing a lot of backlash from baristas. I don't know. It is. It's a tough business
Yeah.
to be in. It's a horrible business to be in. It seems
Yeah.
like.
I like owning companies that don't have labor. There's a difference between labor and employees. All right. Here's another one. Let's see. What was
What about
okay,
the
yeah, yeah.
options thing?
Yeah, I was about to bring it up.
Okay.
Here's the article. Let me read it off. Peloton is repricing options in one of the internal memos. This is a clip from an article, so it's kind of cutting in quickly. Peloton told employees that eligible team members will have their post-IPO options repriced to Peloton's closing price on July 1st of $9.13. That's about 90% off, I think, from the highs. As an example, Peloton said options granted on March 1st had an exercise price of $27.62, and employees were not benefiting financially until the stock passed that threshold. Shocker. After the repricing, Peloton employees will be able to exercise their option after the price passes $9.13. There's so many things to talk about with this from an investing perspective, but generally, thoughts, concerns from looking at a prospective company, like what are you thinking of with this option, the tech employee stuff right now?
So this just means, let me make sure I'm getting it right, that it'll be those same options will vest at whatever the
They can vest at
price is.
$9. Yeah. And I'm not sure if it means more dilution to make the dollar amounts equal. So
I
like it
feel
could
like it
be
would have
triple.
to be, wouldn't
Yeah.
it?
So this could be triple the dilution.
Or it could be a third of the amount at a lower price.
Or a third of the quoted dollar amount. Yeah.
Well, if it's more dilutive, that sucks for shareholders. And it's the thing is, like, they probably would have gotten away with that in 2020.
They didn't have to. That's not something they had to think of.
Yeah. The we're starting to see, okay, there were all those stock-based compensation haters, us included, in 2020, and there were a few companies that were just like ridiculous issuers of stock to employees, and everyone kind of overlooks it during a bull market. And now we're seeing just how much of a problem it can be when a company hitches their wagon to the stock price, Peloton included, but also the big one that I'm thinking of is DocuSign.
Right.
DocuSign had all their, apparently a bunch of their sales reps are all quitting now because their options are like not going to be worth nearly as much as they thought, and they whatever they said, the opportunity isn't there anymore. And Dan Springer talked about it on the conference call shortly before he was asked to resign, and he's like, a lot of the problem is the multiple compression that we've seen recently. Like, I'm tired of everyone saying like, well, there's nothing we can do. It's the business cycle. Like, you
I
put
can't stand
yourselves
that.
in this position.
Exactly. I cannot stand that. That is a huge red flag to me from management. And in general, if someone's heavy SBC, it is a bigger risk. Like that in and of itself, no matter what I think of the business, whatever, is a bigger risk to me because you cannot predict what the stock price is going to do in the short run, even if they continue to execute with their business plan, or with, they continue to execute like you think. It inherently has these risks. Employees are going to get emotional if their stock looks like it's down, whatever the value of their shares looks like they're down 80%, even though the quote unquote value of the business hasn't changed. It is very difficult to convince people of that. And I would just much rather pay people in cash. And if you can't, that's fine. And you maybe have to pay people in stock if you're unprofitable, you're still kind of growing and stuff like that. But as an investor, I want a way bigger discount if a company is doing that. And we're not like against investing in a company that, I'm not against investing in a company that does stock-based compensation. We own some, but it's just another factor to consider. It's definitely a risk, and we're seeing it play out right now. And the risk is just one, employee attrition, and two, heavier dilution than you might have thought.
Yeah, I wonder what all the tech employees that have been getting these insane options I bet part of the thought was, well, you better give me these options because I'm in like I'm in hot demand from a lot of companies. Now that doesn't seem to be the case. Like there probably aren't a whole lot of alternatives. Like let's take those DocuSign sales reps. You don't think equity values have compressed in other places?
Yeah.
I mean, maybe big tech has weathered the storm a little better. Maybe they're going to have an easier time hiring, but you got to, I don't know, just don't don't take too much stock, I guess, as an employee,
Yeah.
and don't issue too much as a company.
Yeah. Unless, I mean, sometimes you have to,
You know what
but
else?
oh, go ahead.
Why on earth? I've been thinking about this. Why did Daniel Eck buy call options?
Oh, the warrants, basic call options. Yeah. Yeah, that's an interesting thing. I don't necessarily like it. Wasn't huge, but I mean, they're gonna expire worthless.
I know it's just a waste of money. It feels so short term minded.
Yeah, it was a bit strange. No one really asked about it, so I don't really have any thoughts on what
I mean, it's his
he
own
was
money, so it's
thinking.
not like a big deal to shareholders,
Hey, the
but it
company got
just
money
feels
because
dumb.
he bought them, so technically the company got some cash for it. But it is super strange. All right, we got a question here. Thank you, Achilles, if I'm pronouncing that correctly, for being the one person I think to join the show every week. On the note of SBC, what is the right way of treating the RSUs and options that will vest in the future? That's the first one. Let's just hit that one first. I think it's very tough. People do the black skulls. Every company does the black skulls model. I like to keep it simple, conservative, and assume whether it actually happens or not that all of them will vest. And I just kind of, I don't think, I think there's a lot of false precision with this. And all I really try to do is look at, say, two factors. One, how many options RSUs, basically combination of potentially dilutive securities outstanding. How many of their like are existing out there compared to the share count, and what is their granting pace historically? And just I like to just not go anywhere further except for saying, okay, I'm thinking share count maybe will go up by 3% a year. Or if say it's a company that's reducing share count with buybacks, it'll go down by 2% a year. I don't like to get any more precise than that. There's no exact math. That's how I like to do it because you just want a general sense, I think, of where the share count could be moving. But there is
Yeah,
you have no idea exactly what's going to happen. I mean, we're researching what Poshmark tomorrow, and they randomly just granted 3% of their shares outstanding in May. Stuff like that can happen. And there's a lot of unexpected things with stock options, which is why management, trusting them, trusting that they're good capital allocators, blah, 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 all that good stuff is so important with this type of thing. That's one of the key things I think I look for in management because it's one of the things that they can control with a lot of, I mean, they have they have all the control there, I think, or majority.
yeah. Here's the way I do it. It's basically the same as yours, and you can tell me if I'm thinking about this wrong. But so I just went to a Dropbox 10Q from like 2018, 2019, because this is the most recent one that was in my mind. But on the first page, it says at the bottom of the page, it says as of April 30th, 2018, there were 73.8, let's say, million shares of the registrant's Class A common stock outstanding. Then in parentheses, it says, which excludes 14.7 million shares of Class A common stock subject to restricted stock awards that were granted pursuant to the co-founder grants, blah, 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 blah. You can choose to include those or not, but if you, we just, we count it. We include it as the fully diluted shares outstanding. And then if it doesn't
Or just do
vest,
both,
great.
or just do both to see how big of a difference it is.
Yeah, you can do both, but that way, let's say they don't vest or they don't hit the options price,
Nice little surprise.
it's great. Like you're on the, it's on the, well, not if you're a shareholder the whole time, probably, but it's
True.
at least your claim on the cash flow isn't being diluted, and
And that's
it's a positive surprise in that sense.
And that is a great point. When having the options there, you typically want to price in that they're going to vest because that means you're right and the stock price is higher 5 years from now. So if a lot of the options aren't vesting, that means, well, you were probably wrong and it doesn't really matter. But here's the follow-up question from Achilles. But what share count do you treat as the actual share count? I think it depends. I like to keep it simple and just start with whatever is listed at the top of the 10Q or K. Start with that. That's the current shares outstanding at the end of the period or the last when they filed the form, and then do whatever, say, go through into the stock-based compensation section of the filing. Look for any sort of potentially dilutive securities that are there. RSUs, options, PSUs, warrants, blah, 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 convertible notes, potentially. Those get tricky, but do the ordinary one and then also add in whatever those are if you want to do a fully diluted share count. But with a weighted average thing that is in the income statement, I ignore that completely. It's not helpful to me.
It isn't. It depends on the company though. So like some companies don't issue stock, like Constellation Software. Their weighted average shares outstanding.
Well, it'll be the exact same. Yeah,
it's gonna be the exact same.
Yeah.
But if you got a company that issues a lot of stock-based compensation, the weighted average shares is going to be very different than the dilutive securities or the fully diluted share count later on. Once those do dilute. So is there a way, I know this isn't going to help podcast people, but is there a way to share my screen just so I can show people where?
Can I give you that option? Yeah. We also got another question. At what level of SBC does it raise a red flag for you? I don't think there is any.
I have no hard rule on that. But
yeah, no hard rule. Participants, I don't even know how to do this.
I'm just looking at the per share performance.
Okay, I'm going to make you a co-host so you'll be able to do it.
The question came from Lars Thorin. He says, at which level of SBC does it raise a red flag for you? If you're, let's say the share count doubles over a year and they spend a lot of money on stock-based compensation.
Doubles. Are you just trying to make an exaggerated scenario?
Trying to make it, yeah, okay. I'm trying to make an easy rounded scenario. But revenue 10x's, and let's assume cash flow is like in line with that. I'm still fine that they paid out all that SBC because my per share growth is 5x. So I would just focus on the growth on a per share basis across all the different financial metrics. But
revenue per share. I mean, the key ones are revenue per share, gross profit per share, operating income or net income per share, and free cash flow per share, or maybe operating cash flow per share too. But yeah, I just do all those per share. And if you want to get, I mean, this isn't even fancy. Sometimes I like to do it with both the ordinary share count and then the fully diluted one, just to kind of see if there's a giant difference and whether we, need to be pricing in any sort of dilution that's coming down the line. But yeah. All right. What do you got here, Ryan?
Yeah. So this is just how you kind of access it. You go to the most recent 10Q. Just so I think some people might not know where this is, so I'm trying to give them an actual good idea. So this is Dropbox as of April 30th, 2018. I don't know if you're going to be able to see that. I'll try to zoom in here. There were 73.8 million shares of registered Class A common stock that excluded 14.73. So I add the 14.73 plus the 73.8, and then at the end they've got another 326.6 million of the Class B. Sorry. So I just added all those. Sometimes it'll say they'll include it if it's in the money. So they'll say, which includes 10.5 million shares or whatever. So then you don't have to add it, obviously. But that's how I get to my fully diluted share count. And that can differ materially from the weighted average figure that they'll report in the income statement, because there could be a whole bunch of options that are issued to employees at the end of the quarter, say, and the weighted average is going to be very different. Plus they could be out of the money, so they might not be included. So that's the best way to measure it, in my opinion.
Yeah. And there's other ways you can look at the share count, like you can go to, what is it called? The state, what is that part called? The statement of shareholders equity. that fourth one that everyone forgets about, that people have to file for every quarter. You can find the share count usually there. And then also near the end of the filing, I usually control F if you're just trying to look for it quick. You can find the stock options outstanding. You can find the specific RSUs. And that's where I'm looking for that granting pace, because that can kind of tell you what the future, SBC, not future SBC, excuse me, future dilution might be. But with that, it's a little bit of inexact science, because you never know when someone's going to start granting a huge thing. CEO leaves and they bring in a new one, they give them a huge grant, stuff like that.
I want to give a little bit of like a painted picture too for anyone listening on the podcast, because I know I just shared my screen and no one can see that over the podcast if you're listening. But the reason we care so much, and this is going to sound very basic, is because your shares that you own are claim tickets. And so even if the revenue, everyone talks about like revenue growth, cash flow growth, and especially at sort of like an inexperienced level, or if you're learning, it's very easy to overlook your claim ticket on that growth or your claim ticket on their financial performance. So let's say the business had $100 in cash and there were 50 shares outstanding, and you had, or let's make it more round, $100 in cash. That was like the whole business. It's worth $100, and there's 100 shares or 100 claim tickets. You own 10 of them. You theoretically own $10 worth of that company, and that's in liquidation. It's 10 of your claim tickets are worth $10. We're not really like modeling it out towards liquidation, but in theory, what are your claims worth on their cash flows? That's why we care, I guess, about the shares outstanding. I know that's sort of a fundamental concept or a very basic concept for probably our more advanced listeners, but
it's very important. So
yeah, it's very important. So we wanted to
that's why
try to give
I
an
like
explainer.
That's why free cash flow per share is truly, and I'm not saying this as an exaggeration, truly the only metric we care about in the long run. That's the only thing I care about. And whether management is, doing rational things with the cash flow the free cash flow that they get. All right. Other topics. Well, the cryptocurrency market.
Good questions though.
Yeah, great questions. Thank you both. All right, other topics. Cryptocurrency continues to deleverage. There seems to be a credit crisis, which I think is funny because it's like a credit crisis and a magic bean credit crisis. I think I said this last week, but you have FTX saying they have $2 billion in cash and they're trying to backstop the cryptocurrency industry if needed. If you're a VC in FTX, do you think are you like, okay, like, I don't know if this is the smartest move, guys, because yeah, you have, you get this take rate or whatever on these magic beans people are trading, which the CEO admitted they are, or magic boxes, but buying them seems to, like, what value are they getting here? If
you're just buying crazy. The accounts, it's not the end of the world. But if you're buying companies that are hemorrhaging cash, I would be very concerned as a VC, especially if you're not just axing all those employees as soon as you purchase the company.
Exactly. And
because you're just hurting your own financial performance.
Yeah. And these crypto investment firms, which I think, whatever, I believe is a bit of an oxymoron.
I was about to say that. Yeah.
There's reports that I guess I don't want to say the name, lost 99% of customer funds, like trying to short Luna, which was a cryptocurrency that collapsed. And apparently it must have screwed up counterparty risk, something like that. And you have companies like BlockFi, like that just totally collapsed. There's this, well, maybe it's known to a few people, but it seems to be this totally unknown leverage in these systems. And to be honest, I'm surprised that the crypto prices aren't down farther, given all these blowups.
I think time is more of the killer. Because if, all right, we keep getting these rallies, or not even rallies. Let's say it's up from like 18K to 21K.
Yeah, it's been in this band kind of, right?
That's like enough for people to feel like, all right, I can get out. And I think if they don't see great returns over enough time, they will get bored of it, is my opinion. And then you'll start to see withdrawals. And so I do think there's like just a time element to it. Because if it drops fast enough instantly, there's still the mindset of like anchoring to what it was and that you're getting it on a discount. Whereas if it's the same, you start to reset what you think the price was. Does that make sense? Like let's
Yeah.
say it's at Bitcoin's at 65K and it dropped to 20K tomorrow. And there is no fundamental value. So your idea of what it's worth is 65K, despite the price being quoted to you at 20. So you think you're getting a discount. If it sits at 20K for a month or 2 months, you start to think maybe it isn't worth 65K, maybe it's worth 20K.
Yeah. And if it doesn't get really materially above 20K for 3 to 4 years, then people might just, forget about it. It's so interesting how this is going to play out because there's people that are super bullish. I got in this super unlucky traffic jam. I mean, it was unlucky for the giant accident, but like the whole highway was blocked, And I listened to all of the Mark Andreessen show with Joe Rogan, and interesting stuff. Clearly a smart guy, and he just seems dead set that he's right on this crypto stuff. So there's going to be money flooding into this, and it's just going to be fascinating what actually happens, because I'm of the belief that it's all just nothing and kind of fairy tales. But
what I don't understand is why are people, there's the moral appeal, or like like, I don't know if it's moral appeal, but like people believe that there shouldn't be a central entity and that it's the currency of the world should be like a function of the market, like a function of buying and selling, as opposed to one potential central entity that can manipulate it. But for what, I don't believe that. But why are people so afraid to come out against it?
Yeah, no, I think I tweeted that the other.
People are coming out now, but it was like people were so afraid of like ruining their reputation by saying like, "Oh, I'm anti-crypto." Like, there's nothing here.
Yeah, it is strange that no one like.
What's changed? What has changed since the start of like?
Nothing's changed.
Like, what tangible benefit has humanity gotten from Bitcoin rising in price?
Well, it seems like people raised a lot of money and threw some nice conferences or parties, but that seems nice. They threw some nice parties.
There's only been detriments, right? Chip shortage.
Oh yeah, I mean, come on, my
waste of resources.
Yeah, if we eliminated it, semiconductors, energy, I mean, it's a net positive to society. It's kind of funny to me. It reminds me of like someone that's like, oh yeah, we're giving some solar panels to this African village, that's super poor. And when Dorsey went to Africa and is like, we're bringing Bitcoin to Africa, and I can only imagine all the people that are like, dude, we just want clean water, electricity, internet, and HVAC. Like, you got billions of dollars. How about you just do that for us? Like, come on. They're like, we're saving the world. And it's like, dude, just get these. You're rich. Let's just get people running water. Okay. Like,
did he ever end up going to Africa? I feel like
he just went there for a trip to meet a bunch of business people, stuff like that, but he never ended up staying.
Yeah, I do wonder if people were like, yeah, listen, we don't want what you're selling, so you can either help or go back home.
We'll take the money, but we're just gonna we need to get some basic necessities for our people.
You know what else there was? Okay, so I looked into I watched the Block Investor Day thing.
Oh, did you block out 5 hours?
It, I don't know if it was that long, but when they went into the crypto part, first of all, they do intentionally keep a lot of it a black box. But one of the segments of their business in there is grants to crypto projects. Grants.
Wow.
They're giving money away. There's no way that is like considered charity. So
Yeah, I mean,
there's no way it's a tax write-off. So they're literally giving shareholder dollars away.
Yeah, I mean, the stock's uninvestable. I mean, it's clear. It's pretty clear.
Even if it's a tiny amount, they're just blatantly giving it away.
Yeah, I mean, if you saw Dorsey's tweet, like this might look, there's a ton of Square block shareholders out there, but if you saw Dorsey's tweet about what was it, expanding the world's consciousness, basically repeating what Adam Newman said about Elon and stuff like that, and you still think it's smart to own a company that he's running, like, I'm sorry, you can't. Like, I just don't think it's just like there's a way. I mean, it could turn out great and they could succeed. But either way, like, say the stock is double from here in 5 years, something like that, right? If that happens, I still don't think it's a smart move to own it today. The risk reward isn't there.
Have you seen Jurassic World, the new Jurassic movie?
No, don't really like those. Not my favorite.
Yeah, I watched it last night. It wasn't spectacular, but
is it streaming or in theaters?
It's in theaters, and
well, your guy, Snohomish, hometown hero.
Oh yeah, Chris Pratt.
Yeah, exactly.
Lake Stevens. He's Lake Stevens guy.
North Seattle hero. Yeah.
There's like this figurehead character that's like loosely based off like this Elon Musk Dorsey type figure who's like basically like the enemy. And in there, in one part, there's like this guy who gives this just full of shit speech where he's like, we've built this dinosaur sanctuary to elevate the world's consciousness, and they're like taking shots at that, like that type of thinking. And then afterward he's like, oh, that was all a bunch of crap, like I don't believe any of that. And so I don't know.
Maybe I should watch it just for that scene.
Yeah, listening to that was kind of an interesting character to see. And it's, I don't know if it's based on any one person actually, but it's like loosely based on like this tech figurehead type character.
Mm-hmm. Interesting. Yeah, maybe I do need to watch. All right, we got probably time for one more topic. Anything else?
I don't know. Got any more of your Twitter likes?
No.
Let me take a look.
It's boring until earnings season, really.
You know what I think about a lot is, and hopefully there's no like AMC people that listen to us, but like, how did that CEO of AMC get there? Like, how did he become the CEO?
No, I think
isn't he like a little crazy?
No, I think he was normal, and then he just played to his, saying this is like a political term, but playing to his base now. He like
do you think so? Or do you think like,
dude, he didn't purposely have his pants off during that thing. You know, he didn't purposely, he's playing to his base and trying to raise money. And I think they are selling stock, which could be a bit selfish and immoral, but I think that's his strategy from what I've read. Yeah. If you,
yeah, I guess that's probably more accurate. And considering that he sold like whatever it was, $100 million worth of stock.
Mm-hmm. Oh,
I don't know. Would you have done the same thing?
It's an impossible position to be in
for $100 million. If you knew you would get the financial benefit that Adam Aaron got, would you act like that and do stuff that is sort of unorthodox?
It's a lot of money. It's a lot of money. But I don't know if the reputation risk, if you're already in that position, I don't know if the reputation risk is there because, you know,
Would
You
you
get what I
rather
mean?
would you rather be rich and respected by no one, or
You can still be like, what I'm saying is you can still have the money you want by not doing that. Just because if you handle the situation well, you're going to set yourself up for success over the next couple, whatever, decades or however it is. Here's another one. Rumors that Avalara, I know this isn't a popular stock, is going to get bought out, which would be disappointing for long-term shareholders because the stock's down a ton. That's something it's a company we looked at loosely. Seems like an interesting business. The topic I want to do though is the risk of private equity takeout below or an acquisition during a bear market that's say a 20% premium, but way, way lower than what you think it can be in 5 years. Is that a huge, I think it's a big risk right now.
I wonder if it's just companies not wanting to deal with the bear market, like not wanting to have to deal with the pressure of employees and the stock and compensation related to that, and how like employee morale, and maybe it's better to just be, well, now that our stock's not going up, maybe we go private.
Yeah, that's interesting. And I think, say we come out of this bear market a year or two from now, whenever it is, I feel like the companies that come out the other side that didn't take the buyout offer, still try to execute on their plan, still acted, you see management acting in ways that you think is not stupid for shareholders, right? That can be a huge positive indicator that this is a company that has their right head on its shoulders. They're the executive team, blah, 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 right? I think that can be a huge positive indicator compared to investing in something company, say 3 years ago, that had never been in a bear market, that went public 5 years ago or something like that, 5 years before that. There's a little more unknown there on how this management team is truly thinking or what like they're actually going to do.
Yeah, it feels weird, Avalara's case in particular, because that felt like a very competent management team.
They
Felt like
outlined a 10-year plan of like,
a
okay,
well-run business,
yeah,
and a business that seemed to have barriers to entry, and they were really doing well. And it was one where I read there was actually a good Value Investors Club write up on them recently, that sort of outlined the competitive advantages and why it's difficult for a Shopify or an Amazon or like wherever you sell to be the provider of that.
Yeah. Why didn't Shopify take them out with stock? Dumb. All right. Yeah. There's no confirmation on this, but it's up 16% on a takeover rumor. So there's something's got to be there. People know.
All right, 2 minutes left. What do you think of the buff dog in Sun Valley?
Yeah, the mask on, stay safe. Old man, it's smart.
Did you see his shirt?
No, he does wear that Hawaiian shirt. Yeah, loves the Sun Valley.
Fluorescent yellow.
Yeah. I mean, yeah, Sun Valley is interesting. It's a great place. I've been there. Not to the conference, obviously, but it's a weird conference for sure. It's where he had the famous speech. It's where he had the famous speech in '99.
Yeah. Do you think he's gonna?
And then Bezos was the only one that went up to him, which is very, looking back now, is like a cool story.
Yeah. All right. You get one CEO in their prime. Who is it?
Okay. Depends on the company, but I am going to go Bill Gates because smartest man. Probably the smartest person that ran a public company the last 50 years. I think. I mean, yeah, I would go Gates.
I think I'd take Bezos. Maybe I haven't read up enough on Gates, but
Bezos did through sheer willpower, turned a bad business and through a little bit of, some good innovation with Prime, turned a bad business into a monster, which I guess that's huge props for
that's what I mean. You think about I always think about now what he's built, how it's just like absolute logistics machine. And
It's
how
not
they
him.
can
It's not just him, but yes, he led the charge with the
and how they can
maniacal- Yeah,
leverage that now. It to me, and it isn't like he did not just fall into a gold mine.
no, it's a hard business. Except for it was a
It took tons of execution, and so I think I think he's going to be my number one.
yeah. What
Rockefeller.
about the
maybe.
TSMC guy? Seemed real, just
I'm not
flawless.
familiar.
All right. Well, yeah, we have the basic choices, Gates and Bezos, but I think they're basic for a reason because everyone knows them. All right, I'm going to end the live stream. That's going to do it. Check out if you're watching on YouTube, you can listen to all the other shows on the Spotify and Apple links or wherever you listen to podcasts live on YouTube every Thursday, 12 p.m. Pacific. Come join us. Thank you all for listening.